Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in Europe. Switzerland's economy took a sharp downturn in the third quarter of this year, contracting by 0.5% amid global trade disruptions and domestic uncertainties. The unexpected contraction, steeper than a 0.1% decline forecast by analysts surveyed by US-based Bloomberg and UK-based Reuters, underscores Switzerland's vulnerability as a highly open, export-dependent economy caught in the crossfire of shifting trade policies under the Trump administration in the US. The Swiss Federal Statistical Office reported that the decline was driven primarily by a, quote, sharp downturn, end quote, in the chemicals and pharmaceuticals sector, pillars of Swiss industry that were hit particularly hard by a blanket 39% tariff imposed by the US back in August. While services continued to expand, the growth was, quote, below average, end quote, and insufficient to offset industrial weakness. Economists point to trade as the main culprit. Quote, 40% of Swiss goods exports to the US was subject to a whopping tariff, end quote, a Pantheon Macroeconomics note observed yesterday. The hit contributed to Switzerland's second quarterly contraction since the pandemic and significantly underperformed the 0.2% growth recorded in the Eurozone during the same period. Now, a provisional agreement struck last Friday offers some relief. The US has agreed to reduce tariffs on Swiss goods from 39% to 15% following intense behind-the-scenes lobbying by Swiss billionaires linked personally to the US president. Switzerland's economy minister defended the outcome in an interview, calling it, quote, the best we could achieve, end quote, and a foundation for further negotiations, while he acknowledged it is not yet legally binding. Zurich-based economic think tank KOF estimates that this deal could boost Swiss GDP by up to 0.5 percentage points in 2026, lifting growth, quote, well above 1%, end quote, assuming it holds. But some political factions remain critical, questioning both the terms and the shadow diplomacy involved. Compounding the economic gloom, corporate Switzerland is showing signs of strain. UBS Group AG, the country's largest bank, has held exploratory talks with the US Treasury Department about relocating its headquarters to the United States, amid mounting frustration over upcoming Swiss capital reforms. These reforms could require UBS to raise an estimated $26 billion in additional capital, an increase the bank calls, quote, extreme, end quote. The potential relocation would be unprecedented and politically explosive, the end of centuries of Switzerland as a major financial player. Not only would it leave Switzerland without its most globally significant financial institution, but it would underscore broader concerns about the competitive disadvantages emerging from Switzerland's regulatory overreach, especially as the US moves in the opposite direction. It is telling that Swiss banks are fleeing Switzerland for the US. The Trump administration is reportedly entering a regulatory phase, potentially freeing $2.6 trillion in banking capacity. Meanwhile, across the border, the European Commission has downgraded its Eurozone growth forecast for 2026 as US tariffs continue to bite. The region is expected to grow 1.2% next year, down from a 1.4% projection in May, with export growth, quote, set to slow down significantly, end quote. For Switzerland, the convergence of external setbacks and regulatory headwinds poses a profound test. The next steps, whether in trade diplomacy or domestic financial policy, could define its economic trajectory for years to come. Next up, we move to North America, but for today, let's make it both North and South America. The United States quietly transferred nearly $900 million worth of its IMF reserves to Argentina last month, a move analysts interpret as part of Washington's efforts to bolster President Javier Milei's fragile economic program ahead of a critical debt repayment. Calculations show that US holdings of so-called special drawing rights, SDRs, reserve assets that can be converted into hard currency, fell by about $870 million while Argentina's SDR balance rose by an equivalent amount shortly before Buenos Aires was due to pay $840 million to the IMF on the 1st of November. The transfer adds to a broader opaque package of US support that includes a $20 billion currency swap arrangement and market operations aimed to stabilize the Argentine peso. The Trump administration introduced the program ahead of October's pivotal Argentine elections, drawing criticism at home for placing US taxpayer funds at risk. Americans soybean farmers, already hit by falling Chinese demand as a result of tariffs, have been among the most vocal critics of aiding a major rival exporter. The underlying mechanism of the $20 billion currency swap line intended to provide dollar liquidity to Buenos Aires also remain undisclosed. Analysts suggest the SDR transfer may form part of that arrangement. U.S. Treasury Secretary Scott Bessent said the administration has made a line of credit available, quote, a small amount, end quote, of which had been drawn, adding that the U.S. had booked a profit. Yet Argentine transparency remains limited. Economists estimate that $2.7 billion of the swap line has already been tapped, with at least a portion used to cover the IMF payment, though they note that authorities have not released any formal documentation. The lack of clarity has unsettled observers. Mark Sobel, a former senior U.S. Treasury official and now U.S. chair of the OMFIF think tank, warned that the initiative represents, quote, a huge risky undertaking, end quote, and noted that it would be, quote, extremely unusual for the US to sell its SDRs to another country, end quote. Overall, US SDR holdings stood at approximately $127 billion in October, but fell by roughly $640 million even as Argentina's surged by the same amount. Fed data indicates the SDRs were not converted into dollars during the month, underscoring the unusual nature of the transaction. The episode comes as Argentina's foreign exchange reserves remain critically low despite a recent $15 billion IMF disbursement, leaving the country vulnerable as heavier debt repayments loom in the months ahead. Though Argentina has seen many successes under its libertarian president, with hopes for continued success in the future, this does leave the country vulnerable as heavier debt repayments loom in the months ahead. But these developments do suggest that the president in Argentina has support in Washington. Now, next up, we have one more development to cover as we move to Asia, but just quickly, if you'd like to continue to be on top of updates like these, how the financial and economic world affects politics and geopolitics around the world, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today we move to Asia. Foreign investment in Chinese equities has surged to its highest level in 4 years, marking a notable turnaround in sentiment toward a market once deemed uninvestable by many international funds. According to the Institute of International Finance, IIF, offshore inflows into Chinese stocks totaled $50.6 billion between January and October, a steep jump from just $11.4 billion in 2024. This renewed interest follows a powerful rebound in Chinese equity markets this year, driven largely by domestic retail enthusiasm and spurred by excitement around advancements in artificial intelligence. Indeed, while many have criticized Western markets, particularly in the US, for being too heavily concentrated in advanced technology, this concentration is even more acute in Chinese equities. Breakthroughs such as DeepSeek's revolutionary AI model have boosted confidence in China's tech sector, contributing to a broader shift in stock prices both on the mainland and in Hong Kong. New listings in Hong Kong have also helped fuel this bullish momentum. For global investors, China's valuation remains a compelling draw. Quote, China still trades at a record discount to the rest of the world, and yet they have some of the best companies in the tech space, end quote, noted Jonathan Pines of Federated Hermes. The country's leading technology firms are widely seen as the only serious challenges to America's dominance in some digital sectors. Although foreign buying is still below the record $73.6 billion recorded in 2021, it is a sharp departure from the multi-year trend of foreign sell-offs triggered by concerns over slowing growth, a real estate crisis, geopolitical tensions, and Beijing's interference in the technology sector. Quote, 2 years ago, China was uninvestable for a lot of people, end quote, said Yan Wang of Alpine Macro. Interestingly, the surge has been fueled more by passive funds than active managers. EPFR global data shows that while foreign active investors continue to trim exposure, inflows into passive vehicles have more than made up the difference. Meanwhile, domestic investors have piled into Hong Kong stocks at an unprecedented pace, injecting 1.3 trillion Hong Kong dollars, $168.7 billion so far this year, and now account for about 20% of the exchange's turnover. However, there is a darker reason into this too. As regular viewers of my other channel, China Update, will know, in mainland China there are very few games left in town. If you put your money in the bank, you are going to see almost nothing in terms of interest rates. The property sector is still mired in a multi-year crisis, one which, as we will see in today's episode of China Update, may still have another 5 years to go. And domestic investors cannot send their money overseas, and so the stock market is really one of the few options left if retail investors want to see returns. And indeed, challenges remain. Geopolitical concerns still remain, and Beijing's crackdown on private business, highlighted by the sidelining of Alibaba's Jack Ma, left a lingering scar on investor confidence. But with regulatory reforms underway and market-friendly signals emerging, investors are willing to take the risk and contemplate China in the era of AI-driven growth. As Daniel Morris of BNP Paribas puts it, quote, "There was a point where people just didn't want to talk about China. Now we do talk quite a bit." End quote. In a world where US stocks hover near record highs, diversified exposure to undervalued Chinese tech firms may look like an attractive bet. But a bet that carries risks that burnt many investors just a few years ago. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I hope to see you for the next episode tomorrow.